Alright guys, so today we are going to go through the literally easiest way to trade. Whether or not it's Forex, indices, stocks, doesn't matter. Okay, the easiest way to trade and profitable. Alright, so when you think back to any sort of form of charting diagram or anything, it could be an emoji on your phone, it could be an example on, Microsoft Paint from when you're a kid or whatever, or, any sort of GIF or GIF. It would always look something like this, right? When you click on a chart, okay? So a chart would look something like this. Up, down, up, okay? It basically shows that the chart is moving in a trend, all right? So it just shows a trending market like this. What I tend to do, and I tend to do quite successfully, and the guys in my group do extremely successfully, is we trade pullbacks. And it's as simple as that, okay? There's no need to massively overcomplicate it. I'm gonna show you on the charts multiple examples of where pullbacks are traded, but I'm going to go into a tiny bit of detail on what I try to identify in a pullback of what to go for. Now, I've got quite a few friends who are involved in crypto, and they talk about, like, they don't mean for it to sound rude, but they don't seem to know what they're doing. Buy the dip, buy the dip. Well, okay, if you buy the dip, that's cool, you are buying a pullback, but there are certain parts of that pullback which tend to have more success than the rest. Okay, so what I tend to look for in a pullback, because that is my style of trading, once you can identify the market, whether or not it's range bound or if it's trending, once you can identify that the market is trending, and by that, you literally just have a break of these highs. So it can be as simple as that. You have a starting point, you have an end point, you get a pullback, so a move down, and then price comes up, breaks above that previous high. Okay, so as soon as it breaks and continues forward, technically speaking, you are now trending in this direction. And the new leg, which you need to look at, is between here, so this part, and this part. Okay, so this is going to be the next pullback zone. So when price starts pulling back and people say, buy the dip, where is it on this leg that you're looking for to get involved? Well, mathematically, and that's the key thing with trading, it's got to work mathematically, because if it doesn't, it's going to be losing. What I tend to do is I use a modified Gann chart or a Fibonacci, and I tend to aim for anything which identifies as a potential bouncing zone or reversal zone from the EQ. Okay, so the EQ is technically the middle part. Okay, so you've got the top part, 75%, 50%, 25%, and 0. Okay, so I tend to go down to at least the halfway point if I can, if there's a pullback available, and I try to find one as deep as possible. Now, price doesn't always come back to the 50% mark or even any further. Okay, it doesn't always do that. Sometimes it will only pull back a little bit and then continue on its way, and that's okay. Because if it did that, for example, I would then be looking between here and here as the next leg, and I would mark out my next part of the chart, literally as simple as that. And I would look for price to pull back to another area, which I class as an order block or blocked orders stuck in the wrong direction, basically, waiting for price to come back down, mitigate it, and bounce off again and continue the trend. Now, in order to make this work, let's just use this middle part for an example. Let's say that we have an order block at the extreme. Okay, so we're just going to pretend for the time being that we've got an order block right at the extreme. So this could be a downward facing candle, it could be an opposite candle. So I tend to use white candles which lead up and blue candles which lead down. So let's just say, for example, that this is a blue candle facing down right here before white candles leading us up, and price tends to pull back in. The reason why I like to try to target the extreme where possible is that mathematically, as I come back to, it works the best, because we know that our target, at least the initial target, is likely going to be this swing. If we are pro trend, which means that we're going in the flow direction of the market, we want to at least break this high. It doesn't always happen. Sometimes price will come close to it, pull back a little bit further, and then break through. Sometimes it doesn't even reach it, but about 60% of the time it does. So I tend to put my stop loss just behind the nearest swing, or just behind that order block, let's say. I get my entry on there, and I get the best mathematical chance of making it work. So even if I won, for example, I know this is just an example of, let's change this so it's a 1 to, let's say it's 1 to 7, right? We're going to pretend this is 1 to 7 in risk reward ratio. Let's say that I get this right only 50% of the time. That means that I'm still going to be positive out of, say, I don't know, 2 trades. I'm right 50% of the time, so I'm going to lose one, so I might be -1, but then I'll be +6 after I win the other one, which is +7. So mathematically, it doesn't matter if I'm losing or if I go on a losing streak, because I know that I'm owed a win very soon. Okay, so that's what I tend to do. It's literally just trading pullbacks, and it is so simple. It's how the market works. All right, it needs to continue in the direction where it's going. It could be a downtrend. Okay, it could be really simple, just in a downtrend, doing exactly the same. As soon as you get these breaks of structure, it's indicating that the market is continuing in that direction. And where do you want to be placing your orders? Ideally, in the furthest point back. So these are known as points of interest, or order blocks, or opposite candles, or supply and demand, or whatever, some sort of form of structure. You want to try to target as far back as you can, or I tend to anyway. Another area which is extremely successful is the EQ. Okay, so we looked at here at the EQ, and I spoke about the EQ really briefly, and we will get into the actual charts in a second. But I do tend to find that when there is a order block available on the EQ, and especially if it has reacted previously from that sort of level, the bounce rate is very, very high. Okay, so it's not above 50%, it's about 45%, but the bounce rate is pretty high, and it's high enough for me to be able to say, right, okay, I need to try to shrink my stop loss and get a very tight entry on this, and try to get, you know, a 1 to 4 or a 1 to 5, because if I'm right, say, I don't know, a third of the time, for example, I'm still going to be profitable in the long run. Okay, so really, really simply, just like that, let's have a quick look at the charts. So these are the live charts at the moment, and you can see that I've just missed a trade today. A little bit frustrated with myself because the actual pullback was here. Okay, I'll talk about that in a second. On the top left over here, you'll see the 4-hour chart, and down here is the daily chart. All right, so these are my live charts, still watching for the market, waiting for an order, possibly to come back into here and pull back. So I'm just going to talk through really quickly. Let's switch this main one to the H4, just to give you a sense of direction where I think that the market is going. All right, so let me just tidy up the chart a little bit so I can use it a bit later. Okay, so I'm just going to do general swing structure. All right, so we've got a starting point down at the bottom, which happens to be the daily low. Work our way up. We do get a bit of a pullback. Work our way up. We get a pullback. So on here, for example, we've just pulled back to the furthest order block available, which was down here. Price came up, pulled back a little bit, came up, pulled back a little bit, came up again, pulled back a little bit, and possibly will break up that way, or will break down that way. But it looks as though it's probably going to go that way. And all that I've done is I've just identified the order blocks, okay? Or the most likely places where the market's going to reverse from. So if we look at this one, for example, price came down, grabbed liquidity or whatever it grabs, you know, the opposite orders, grabbed them from this last order block before it broke up. Price came down on a lower time frame. There's another one here, so it literally just grabbed it from there. Price came up, grabbed another one from here. So it just continues to do this over and over. And mathematically, if you're just placing orders in these places, so an order there to go long to carry it all the way up, an order here, where is it? To go all the way up, even just to that nearest swing. An order here, which happened earlier today, to go all the way up, even just to that swing. If these play out, which they probably should, 6 point, call it 7. This one, 4.5. That one, 4.5. That's pretty good going, and that's just looking at the 4 hour. Okay, so that's not even intraday trading. All right, so we're just going to drop down to the 15 minute and see where price has done the same again. In a matter of fact, let's talk about more sort of specifics on the M15. So the H4 was the bigger time frame, the bigger picture, let's say. But with this, we're trying to identify where price is likely going to react from. So we knew that this was a swing point on the H4. So remember back over there, this was one of the swing points on the H4, and this was a low on the H4. All right, so we were expecting a reaction from price up here, which we did get earlier on today. Price came down, grabbed something out of here on the 1 minute. These were wicks on the 1 minute. Price came down, reacted from there, worked its way up, didn't break this swing point. So this is classed as the extreme on a leg. Okay, so this leg being here to here, this is the extreme. This is the furthest point you can get in until you're wrong. Okay, so if you want to place an order from up there, like which I wanted to do, and actually work it all the way down to the bottom, it would have been a 20-hour trade. Okay, but the actual order wasn't where I've placed it there. It should have been where everyone else in my group got involved, about there, and they also took profit in the correct place, which was the demand coming into the market. However, okay, so this being the extreme, if price was to have worked its way through and just broken through there, everyone would have lost -1, and that's absolutely fine, because mathematically, what we would look to do then is this leg working from down here to up there. We would then look back down to this leg and look for a reaction point, which is likely going to be an unmitigated area of demand, and that's one of the tools which I use. So I'd have been targeting either this candle or this candle, and luckily it reacted from the bottom candle, which was also the extreme. This is the one which hasn't been mitigated at all, really, and it's also the furthest one where if price was to have come down and taken me out, well, who cares? Because it was the furthest one available. Because if I'd have got involved off of this candle in roughly the right place, I'm just going to do this roughly, and we wanted to go forward and break the high of that leg, which was there to there, or sorry, there to there, it would have been a 10-hour trade. All right, so it's literally, once you get your head around this, and the fact that all what I do is I trade pullbacks, I identify different areas on a leg, areas which are most likely going to hold really strong, and then I drop down to a lower time frame to try and identify an area within that area, like what I did here. Didn't work this time, but for others it did, because they didn't refine it as far as I did. But all I do is that. It's literally as simple as that, and you follow the flow of the market. So just to recap, all what you're doing is you're identifying which direction the trend is going, and you're looking for anything below 50%. So when price is starting to pull back, you want to look for anything which is below the 50% mark, anything below this red line, to try to get involved. Place your order when price comes into it, or set your order way before. Target at least that swing point. And the reason why you do that, by the way, is I know that price needs to run through it technically to continue the trend, but price doesn't always do that. Sometimes it will literally just come up to it and start pulling back and do what's called a fake out. And they happen from time to time. It's just a normal part of chart trading. But generally speaking, you just want to maximize your chances of actually taking profit. So from here, you're hoping to see that. And then what you will create, as soon as price starts pulling back, so as soon as price starts pulling back again from here, you then know that this leg has been finished with. You don't want to react to any order blocks within there anymore. You just want to look at this new leg which has been formed. All right, so this becomes the important leg, and then you start looking for order blocks which may be active, so technically unmitigated, preferably unmitigated. You want to see price come back down to one of these, set your order, put your stop loss in the correct place, and target the new high. And hope that price comes up, creates a new high, allows you to then look at a new leg, target a new order block, like that, get involved when price comes back to it, and then break a new high. And that's it. Right, so there's no need to look at any ultra complicated strategies out there. I know there's a lot of people doing SMC and all sorts like that. Not knocking it, My strategy, I guess, is relatively similar in some ways, but you really don't need to complicate your trading. It is as simple as that. Use the mathematics behind it. Use an Excel spreadsheet or Google Sheets or anything where you can record the data and just run the maths on it. This has been compiled, even though as simple as it looks, it's been compiled pretty much over the last 4.5 years with just over probably now 12,000 trades in there. And I know the mathematics behind my trading and it works extremely well. So I hope that you've enjoyed the video. If you have, please do give it a thumbs up. Drop me a comment, ask me any questions that you want. If you want to join the Discord group as well, which we have going, there's about 50 people in there. I cap it. I make sure there's not too many people in the group at any one point. Why? Because one, it's not a signal service, even though there are signals given. And two, I want to make sure that everybody is actually learning how to trade correctly. And three, if there are too many people in there, it will get saturated and nobody will get any quality from it. All right, so I want to make sure that there's quality throughout. I want everybody to be trading the same way. We don't trade any other concepts. It's only my concepts how we trade. So slowly but surely we're getting there. I'm going to be opening the doors again in about a week's time to probably another 15 traders. And it'd be great to have you in there. But yeah, if this is the first time you've seen one of my videos, subscribe, watch one of my playlists, and you'll figure out very quickly how I trade and how I make money in the markets. Thank you very much for watching, and I'll catch you soon.